welcome to the Fat Sale Investment Podcast. I'm Callum Newman. Got a really big episode for you today. We've got James Allen coming on, who is he runs the new energy investor service for us here at Fat Sale Investment Research. Now, James is based over in the UK and he covers renewable energy, lithium, all the battery metals, etc. But one thing I was going to ask you about is carbon credits, which has turned into an investable asset class. And I was reading about a fund manager the other day who's got something like a 60% return over the last year from buying and holding these carbon credits. So I wanted to find out about that, and James will give us the lay of the land of what's happening both there and in the renewable sector in general, because it is going to be a big trend, decarbonisation, for the next 20 years. So it's not something that we can really ignore. And the profit potential in lithium stocks over the last couple of years has been enormous, but there's lots of other things going on as well. But first, I want to bring to your attention a couple of stories that I saw that are worth watching for on the market. And this is from the Australian newspaper, and it's about television advertising, saying that, and I quote here, television networks reveled in double-digit growth in their advertising revenue last year, with catch-up viewing services yielding the biggest increases. So that suggests to me a couple of things. One is that advertising has come back in a big way. So clearly those guys think that consumers are willing to spend and are confident to spend. So that would tie in with what we know about the increased savings because of COVID, and with house prices on the rise, that generally kicks spending along as well. So interestingly, whenever you see a news story, my old mentor used to tell me, go and compare it to the stocks on the market. So there's a couple of advertising TV stocks that you can look at. One's 7 West Media, which is Channel 7. One's Channel 9, which is pretty obvious. And then there's another one called Media, which does outdoor advertising. So there's 3 stocks you can follow. And another good stress test that we've had, the market's been spanked lately. So those 3 have largely sailed through so far okay. Obviously, the volatility came in, so they did get sold down. But I know with 7 West, that was actually a free trade I gave away with my presentation in December. It's still up 20% thereabouts since that date. So that tells me that the market bought the dip. So even when it sold down a bit, the fund managers presumably stepped in to buy it. And that story in the Australian about the strength of the advertising market would suggest they have very good reason to do so. So keep an eye on those 3 stocks. They'll all be releasing their earnings announcements in the next couple of weeks. Now, on to our second story, and this ties in a little bit with why we get James on. Now, this one is about industrial rents, and it's in the Australian Financial Review, and it says industrial rents will soar by up to 50% over the next 5 years due to dramatic mismatch between supply and demand, blah, 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 blah. We don't need to know about that. This is why I wanted to bring it to your attention. Basically, this industrial land is going up in the inner cities because of the e-commerce trend. So companies need to have their stock nearby to get it to you as fast as they can. So that's the competitive pressure. So the reason I bring that up is because the analyst here says that the rising rents, and I quote, won't be an issue for e-commerce users who can defray the higher rents through cheaper fuel costs and faster delivery times. She goes on to say only about 10% of their overall cost is rent, while about 50% of their cost is transport. End quote there. So what does this have to do with renewable energy and James coming up? Well, the existing transport system, which is their highest cost, is obviously based on oil and fossil fuels. So oil is very expensive at the moment. It's $90 a barrel US. It's even more expensive for Australians. Now, what does that mean? So as the electric vehicle trend plays out, that's going to cut out the oil business from the transport sector. What will eventually happen is we will have electric cars that are fired by batteries, which are in turn fired by solar energy. Now, I saw some stats recently that solar in the US is about at least half the cost of coal-fired generation over there. So simple economics says solar is coming to wipe out the fossil fuel industry, and that eventually everything we do will be off batteries. So that says to me that over the long term, rents in the property sector, in this industrial sector, can actually keep rising if those costs do come down. So if we do see delivery companies, logistics companies, this last mile trend switch over to electric vehicles and they run it off cheap solar, they'll be able to afford higher rents again. So that's just one way that the property cycle can keep going, which not many people would see. Now, look, it could be that I'm not right about that and that thing doesn't come out. But if it does happen, that will allow those businesses to pay higher rents, which will in turn drive up property values in those affected areas as we go along. So keep watching out. Anything that cut costs in the economy will drive up land values wherever that can happen. So obviously solar is a trend that James is part of what he follows. So again, we got him on to talk about what's happening in the renewable energy sector and carbon trading, carbon credits, and the view from Europe, where he's based, and what's happening around the world. So here's James.
Around the world, renewable energy use is on the rise. And these alternative energy sources could hold the key to combating climate change. While renewable energy presents some challenges, it also offers an environmentally friendly alternative to the greenhouse gas emissions and pollution of fossil fuels. And as advances in technology make renewable energy more accessible, affordable, and efficient, an end to climate change could be within our reach.
All right, we're discussing today one of the biggest trends in possibly market history. That's at least the view of one fund manager I read about recently, where he talked about decarbonisation being bigger than the internet. So in lieu of that, I thought I'd get on our new energy guru, James Allen over in the UK. How are you going, buddy?
I'm very well, thank you, mate. How are you?
I'm good. Now, I'm trying to remember the last time we spoke, which I think was back in 2020 that we certainly launched New Energy Investor here in Australia, I think.
That's right.
Just before we jump into the topic, how did you begin to specialize in the new energy space?
So I'm a former journalist in energy markets. So I was doing that for many years. I then, after sort of heading up like a desk in London, I was then sent out to America to start a New York bureau, sort of covering the wider energy markets, shale gas and things like that, which was kicking off, I suppose, in America at the time. And more and more sort of the renewables were coming into conversation. They were driving prices, so I was becoming increasingly interested in what was going on in the renewable space. And I then got sort of tapped up by the South Bank Investment Research guys to come and set up a newsletter focused on renewable energy in Europe, where basically that was sort of leading the charge in terms of decarbonisation in the world, really, at that time, for some of the factors we might talk about today in terms of offshore wind, solar, and specifically the European carbon markets, which was in full force at that point. So I set up lots of opportunities were becoming obvious in that market at that time. So we launched the newsletter a few years ago, and it's been a bit of a roller coaster since then. We had a phenomenal year in 2020 when the markets really woke up to the opportunity at hand and what we needed to do to reach our overarching net zero targets. And then there's been a bit of a profit taking this year. Last year, I should say. And it's been as we know, the growth side of the market has had a bit of a hit so far this year so far, with expectations of rising interest rates as well. So I think the macro situation hasn't helped so far this year, but I think actually fundamentally the market is in incredibly good shape. We're seeing lots of new projects come online, renewable forecasts set to smash it out of the ballpark this year. So fundamentally the market is in very good shape.
Well, it's funny you mentioned 2020. I know from personal experience here in Australia, if there was one spot you wanted to be since 2020, it was lithium space. Some of the gains have been astronomical there.
That's right.
And just in terms of opportunity, that just doesn't come along that often. But you mentioned in there carbon credits, and this is why I reached out to you, because this is not an area that I understand particularly well. I know because, like, I'm an Aussie, right? So, say 10 years ago, maybe a bit more, one of the governments tried to introduce a carbon tax and this kind of thing, and then it got shut down. But then I started seeing stories like this. So I've got this little one here just from this morning. And it says, the headline is Carbon Credit Lifts Tribeca Investment Partners Fund to 60% return in 3 months. And it's to do with the surging price of carbon credits. Now, I don't know, is this more of a European thing, an American thing, a world thing? Can you tell us about carbon credits?
Of course, yeah. Well, there's no global price on carbon. And Europe has the main carbon market. There's some other ones in America, China as well, trying to kick off its own carbon market. But the main carbon market is the one in Europe, which was set up over a decade ago now, and it's a cap and trade system. So it effectively puts a price on carbon emissions from around 10,000 power plants and industrial installations. And it's administered and regulated by the European Commission. So that they set a cap on emissions each year. And the European Commission does that by issuing a certain amount, a limited amount of European Union allowances, EUAs, every single year. And then basically allowances are either handed out for free of charge to certain industrial companies and installations that are eligible at the start of the year, or they're auctioned off every single day. So at that point, companies can buy or sell physical EUAs for immediate delivery, or they can then trade the futures for delivery any time up to sort of 6 years ahead. So basically, there's a real market. It's a paper market, but so
when you say that they're auctioning it, as in a company like an oil company goes, right, we're emitting X amount of carbon, we need to offset it by buying these credits.
Basically, exactly right. So there'll be a cap on emissions now. A company, a power plant, if it's forecast or if it thinks its emissions are going to be higher than that amount, it will then need to go into the market and buy extra allowances to meet that extra demand, essentially. Likewise, there might be other installations or factories, power plants that aren't going to emit up to their allowance. So therefore, it will be long allowances, and therefore it will look to sell its permits. So
which I think Tesla sells its credits, doesn't it, in the US?
Yeah, that's a different type of market. They have a sort of a different market in the US, but they at one point they were long their carbon, and they generated a lot of their early income from carbon credits at the beginning. Exactly right. Yeah, in Europe, the main companies, installations, it's factories, it's industry, and it's power plants. It's coal plants, gas plants. They're all heavy, polluting, power plants. Basically, they're the people in the market. But we're getting other sectors coming into the market. We're getting maritime. We're getting shipping who are coming in, and there's other sort of sectors coming into the market. So the market's actually getting bigger, which means demand is getting bigger, and the price therefore should go up.
So that all makes sense in terms of environmental regulation, and I get that. But then the way that this fund manager is talking, he's using it as a way to make money. Is that something that you've explored for your readers?
Oh, well, completely. Yeah, that's right. Yeah, for new energy investor, we've hopped back onto the there's an ETS which tracks the price of European carbon. Likewise, the UK used SO1. We actually got in a bit earlier because that product was launched a bit earlier. We got in, I think, when that price was around about 7 or 8 euros, and just today it's just shy of 90 euros per ton. So it's had a phenomenal run over the last few years, but I think there's lots more to come. But it's been up and down. We had obviously when the sort of COVID hit and factories were sort of shut down, and demand for energy was less, so there was much less sort of emissions basically at that particular moment in time. So the demand of carbon shrunk. So there was a bit of a surplus in the market, so prices came off. But actually, since lockdown has been sort of eased in Europe, prices have been on a real tear, basically. And they just got shy of 100 euros last year. They just above 90, I think they hit, and they're just shy of 90 now. So I mean, lots of people like myself are predicting 3-figure carbon pretty soon, really. I think the trend really is going one way. There's not many risk factors which suggest prices could come off. There are a few, there's profit taking, but essentially the market is getting bigger, demand is getting stronger. And right now, even at near record high prices, it's not still doing the job that it's designed to do, which is really cut emissions. You've seen this year with high gas prices, basically. So carbon has gone up in sympathy with gas prices, but still you've actually had coal. It was meant to the whole point of carbon in the power sector is meant to disincentivize the running of coal power. But actually, it hasn't done that because that coal has still been needed on the grid because we've been so short of available power. So actually, the price of carbon actually really should go higher to take off that coal off the grid. I really do think at some point soon we'll go into a different paradigm. I think way above 100 euros.
Just to touch on that point there, because the critics of renewable energy go, oh, well, look, the sun doesn't shine all the time and the wind doesn't blow. Therefore, you end up short on the grid. You have to have coal and gas as backup. How do you view that debate? I think right now, yes, there has been a job certainly for those fuels, certainly in Europe. I mean, but that really is a function of not actually investing more into battery storage and other forms of energy storage over the last few years. I think as we move forward, I think certainly Europe is trying to invest more into battery storage, more into long-form duration storage, which doesn't have to be sort of lithium-ion, really to cut the use of gas and coal off the grid. Whereas they've been there to help. Certainly, gas has been there to help balance the grid at times when we've been short of intermittent renewable energy. But as we move forward, there's much more investment going into battery storage, energy storage. So therefore, hopefully, we will become less reliant on gas. We're seeing right now, I mean, energy prices are sky high in Europe, and that's because of Russia politicizing their gas supplies into Europe. They've cut supplies, and that's a fact. And we've seen the whole energy price environment rocket. So the less we can sort of rely on fossil fuel, natural gas in Europe, the better. It's interesting. I saw a stat come out from our colleagues over in the US, and they said, at least in America, to use a coal plant to generate electricity costs between $65 and $150 per megawatt hour, and to build a solar or wind plant is less than $30. I mean, simple economics says that they're going to get wiped out. Do you have a timeline before that happens?
It's hard to give a timeline. I mean, certainly there's no real economic case to build new coal anywhere really. What we're finding is we've still got a lot of incumbent coal on the grid, still in Europe, obviously a lot still in the States. There'll come a point where it becomes cheaper to build new renewable plants than actually run incumbent existing coal-fired power. We're not quite there yet, but that day is coming for sure. Certainly with high carbon price environments, that brings forward that date when that happens, basically, because it's these coal-fired power plants with €100 carbon, they're very hard to make a profit, basically.
Yeah, I was just thinking as you were talking about the carbon credits before, like, okay, if you're long carbon credits, you're making money or whatever, but if you've got to pay those or factor them in, it's prohibitive to.
It gets very expensive, exactly, and if you don't meet, if you don't meet your allowed amount of emissions, basically, if you haven't bought enough carbon permits to offset your emissions, you're effectively short in the regulated markets. You then face a penalty of €110 per ton, which comes out every sort of April. So therefore, that price really should at least hit that €110 because the market is essentially short. So yeah, it's a very, very expensive game for these factories for coal-fired power in Europe, certainly, to be running coal at the moment.
One of the issues so clearly Europe is taking the lead on this, but in a sense, they're making their companies less competitive if the other countries like China go, well, we're not going to do that. I mean, so one thing I've seen from the steel industry is Europe saying, well, we're doing this. Therefore, if you export to us using coal energy, we will tax you. We will put a tariff on you because we will not disadvantage our homegrown companies. Like, kind of like, we're doing the right thing. If you don't, you don't sell to us. Is that happening? I mean, I saw it in the steel sector. Is that elsewhere as well? Is that the general?
That's happening. That's happening in Europe. There's legislation for that to happen soon in Europe. Also, potentially in the UK as well, because the UK now, since Brexit, has its own European trading system. Carbon trading system as well. So that is certainly happening. Obviously, there's been lots of pushback from industry, from manufacturers who don't want this at all. They don't want. They want a sort of level playing field. But essentially, this is there to protect them. So that is certainly happening. But it is, until we have a global carbon price with everyone playing by the same rules, then we're going to get this, unfortunately.
And I mean, do you see positive trends happening in that regard?
There's been talk of a global carbon price for many, many years, but it's just there's political will for it in certain quarters, certainly in Europe. I mean, there's still not a standardized US carbon price. They have a system in California, they have a system on the East Coast, and nothing really in the middle at the moment. There's a small market in Canada, but at the moment, there's no real political will in the US to standardize their carbon markets. So until that really happens, I can't really seek any form of consensus for the rest of the world. I mean, Australia, you were a leader in some ways in it for a carbon price, a carbon market a decade or so ago, but that conversation has really sort of drifted off now. I think it became sort of politically toxic in Australia as far as I remember. So I can't see. It's one of those things. It's often talked about having a global carbon price, but really I can't see that happening for the time being.
Well, it's strange.
I think we'll get certain. You might get the European market having some form of deal with Switzerland, say, or China, say, in time, where they'll start to have some form of relationship, and maybe that'll be tacked on with the Californian markets. But for a carbon price for the whole of the world, I think that's looking unlikely at the moment. But you'll certainly get a beefed up regional-based sort of carbon markets popping up.
Well, anybody out here in Australia who's listening to this or watching it will want to know about the battery metals. As I alluded to earlier, lithium stocks have gone absolutely bananas out here over the last 2 years. There's always the chatter about manganese, nickel, cobalt, even rare earths, etc. Do you follow the mining space with that in mind, or do you play this sector in different ways?
No, I look at the mining sector as well. I mean, it's obviously 2021, you had a lot of the sort of clean tech companies, a lot of the solar companies, wind companies. They'd had such a good year in 2020, they sort of came off a little bit. The companies that did well were actually the battery metal companies, the lithium stocks, the nickel stocks, cobalt. Graphite now is starting to pop as well. So some of those graphite companies look really very interesting as well. But I think there's an overarching shortage of material compared to some of these demand forecasts for electric vehicles. So I think that's a really good way to play the energy transition, looking at some of these metals. And obviously Australia is blessed with many opportunities to play that market. I mean, lithium is a phenomenal play. The lithium price is at a record high right now, but I still think there's a way to go. We've got such a bottleneck coming down the pipe with compared to supply. I think it takes a long time for lithium mines to get up and running. There's a real shortage of sort of battery grade lithium, and I think that's a really good way to play it. I think that trend is going to carry on.
There is a paradox here, though, that, at least as I understand it, the key to getting electric cars on the road is bringing the cost of the battery down. The more and more, as you say, if these bottlenecks are real, that the prices of the commodity, the inputs go up, but the harder it is for them to do that.
Yeah, exactly. This is one of the risks of in the energy transition. I guess I think over the last sort of decade or longer, everyone's come to expect falling prices, and that's what has happened. I think battery prices have fallen 80% over the last decade. It's had similar falls in solar, similar falls in wind. But certainly in terms of the battery space, I think the rising price environment for the core minerals, I think that does pose a bit of a risk. That's why we're seeing lots of these auto manufacturers, so these car manufacturers, they are looking to shore up their supply now before it gets too late, before this the lithium price really goes to sort of unreachable targets essentially. So that's why we're seeing a real scramble right now. Tesla just announced a deal with the graphite stock out in graphite company, an Australian-based graphite company.
That was Ciro, wasn't it? Ciro recently.
That's Ciro, exactly. That's right. Yeah. So there's lots of things happening in the graphite space as well, and that's replicated really across the battery metal supply chain. I think lots of car manufacturers really have got work to do really to shore up their supply, knowing that prices could well continue to rise.
Talking about battery metals, like to me, it's genuine, but it's also very, it's an obvious kind of idea now. Like as we said, we've had a big run and we know the interest is really huge. Is there somewhere in the renewable space that you think people aren't watching that might be intriguing at all? Yeah,
I would say graphite for me actually is the one that's been not been so much talked about. Everyone's talked about sort of lithium, obviously, cobalt, nickel. Graphite's been quietly getting on with it, and actually the price didn't do much last year, but now it's just starting to sort of bubble away, and you're seeing these deals like Tesla, and there's now a bit more focus coming on graphite. And I think the graphite space is really hot, could potentially really hot up. I think that's a really key area. I think that would be a good way for investors to play this trend. I think that's going to be the next market to really pop. Seeing lots of new deals in the space.
Is graphite? With the batteries, you read about the anode and the cathode.
Anode and cathode. So it's the negative part. It's the anode. I think it's the vast majority of the anode material is made up of graphite. And even though on the cathode side, there's lots of conversation about changing the composition of the cathode, nickel, cobalt, everything's sort of changing. Actually, on the anode side of things, graphite's set to be dominant. It's dominant right now. It's set to be dominant for the next few decades, really. There's not many sort of alternatives. So that's a really good way to play it, really. Cobalt on the cathode, for example, people think cobalt is going to be reduced on the cathode side of the chemistry. But in terms of the anode side, I think you haven't got many other choices apart from graphite right now. So, lots of the material is also sourced in China. And that has its own sort of supply chain issues as well. So I think there's lots of demand for non-Chinese production, basically. So some of these, I know Ciro had had a production out in Mozambique. There's some others in Australia. There's some in Canada, North America. I think and in Europe as well. They're very good ways to play this market. I think looking at sort of non-Chinese based graphite supply, I think that's a very, very good way to play it.
One thing I've noticed with your newsletter, obviously you've got a world market, so it's a world opportunity, but that of course means you've got to go all over the world so as far as I know, you look at stocks in the UK, in the US, in Australia, probably in the EU as well. I mean, is there one particular area that you think is stronger for this kind of themes and ideas, markets?
There's certain exchanges which sort of attracts a lot of clean tech capital and clean tech stocks. I would say that the predominant ones actually are in Canada, UK, some of the European markets like Norway and France aren't bad. I'd say there are some of the, and obviously the US as well, but some of the real small ones where there's some lots of opportunity would be those ones I just mentioned. But Australia is becoming increasingly interesting as well. I think there's so much opportunity in Australia. There's lots of not just sort of on the battery materials side of things, but actually other companies and solar companies, the wind companies that represent a really good hydrogen companies. Obviously, hydrogen is obviously a huge growing space in Australia. There's lots of interesting things happening there. So
can you just hydrogen is a funny one to me. I keep hearing about it. I don't even really understand the case for it or even what it is. Have you looked into it much?
Oh yeah, no. Hydrogen was like probably the story of 2020, I guess. I think people woke up to the opportunity there. Hydrogen really is seen as a bit of a panacea to help the world really decarbonize. There's different forms of hydrogen, but the form that everyone's really getting excited about is green hydrogen, and that's made from surplus renewable electricity. So its feedstock is effectively is renewable power, so wind or solar or like, and effectively it's run through an electrolyzer machine, and out of that you get with a load of water, I should say, but out of that you get hydrogen. Now, up to now, hydrogen has been it's been made from with natural gas effectively, so that's blue hydrogen, which still obviously burns. It's burning a fossil fuel. It's it's not great for the environment. But green hydrogen, so you what you get from the surplus power, you get this resource. With that hydrogen, you can, in theory, you can put it in your car. Essentially, or down the line, there's going to be, because then you have fuel cell cars or trucks. For hydrogen's potentially very good for sort of heavy duty trucks and lorries, because with the fuel cell, you can turn that hydrogen into electricity effectively. Likewise, it can also provide a solution for heating. So rather than Europe beholden on natural gas for its heating stock, you can actually use hydrogen to heat buildings and homes and things like that. So, and also it helps in industry, farming as well. So hydrogen can really help sort of decarbonize fertilizers. Industry.
As far as I understand it, it's not quite cost competitive yet, though. Is that right?
That's right. It's fantastic on paper right now. Hydrogen. Everyone thinks it's a phenomenal solution, but it's too expensive right now. But saying that, with this high natural gas price that we have right now, it's actually become comparable, even a bit cheaper in certain times, with so-called blue hydrogen. Blue hydrogen is hydrogen made from natural gas, and effectively you then store the carbon. So even though it's you're not still getting that many new sort of green hydrogen projects coming up off the ground, but actually the trend is moving completely in the right direction. We're getting 5 years, so less than that, 2 years ago, the conversation was blue hydrogen would come first and then green. Actually, now it looks like blue hydrogen is going to be priced out of the market straight away, and let's move towards green hydrogen in time. But yeah, we still need prices to come down for green hydrogen. That's going to happen by the electrolyzers. We need that process. That is still quite an expensive process, and we need those prices to come down.
Australia's richest man, Twiggy Forrest, who runs Fortescue,
Twiggy Forrest, brilliant,
has started to pump a lot of money in research.
He's a real pioneer. Yeah. He's an amazing advocate, not just for hydrogen, for the whole clean energy space. He's actually brilliant. Some of his talks he does are just really inspiring. I think he's one of the real leaders of the whole space. Yeah, I think we need more leaders like him for sure.
Well, it's interesting what you talk about parity there, because it occurred to me when you're talking about carbon credits with the companies in Europe, it kind of occurred to me that the logical conclusion of that trend is that you and I will have to buy credits if we drive our car, or in some way. Do you think that's possible? It goes to the individual level, and they go, "You've got a big house."
Potentially. That's sort of happening. It can happen. Like I don't know about Australia, but in Europe, you can when you go on an airplane, you sometimes get the option to offset your emissions with you can tick a box, can't you? And some of your emissions are offset. And that's the airline will go into the voluntary markets, and they will buy a carbon permit equivalent to your emissions for that flight. And that could be it can be a forest or something. They're forest being built somewhere around the world with lots of trees, and they offset it in that way. But that's the voluntary market. It's still a relatively small market, a growing market, but in time that can be spread out to every retail investor, or every person just going down the street who either wants to do good, or right now it's actually quite a difficult market to get into for retail investors. But soon, I think it's going to be opened up to everyone. Really, people might just want to make, off their own bat, just want to either make money, or B, just to offset their daily emissions. Once that happens, I think that, and there's a vehicle for them to do that. I think again, that's all that's going to do is drive demand. I mean, that's certainly the way it's going.
It's interesting with the oil price quite high at the moment. Obviously, here in Australia, well, everywhere, petrol prices are rising. So it's a cost of living issue where people go, geez, it's starting to hit the hip pocket a bit when I fill up the car. But in a way, that mentality will either change or be forced to change, because the logical conclusion is like, let's pump more oil and get it cheaper, and you can drive as much as you want, and all that sort of stuff. But we're in a different world now, isn't it? Where essentially the governments could come in and say, we want a high oil price to stop you using the damn stuff, and to make those other techs competitive.
Yeah, that's exactly right. Yeah. I mean, the higher the oil price, really, it can be just an opportunity for some of these sort of newer technologies. If it becomes so expensive to sort of put sort of petrol in your car, then suddenly an electric vehicle becomes quite an appealing thing to buy. So that's the way it's going. I have an electric vehicle, and it's you pay a higher upfront cost, I guess, relative to a normal sort of internal combustion engine car, but actually the running costs are really cheap. It doesn't cost much at the moment to fill up the car with electricity, fill up the battery. They run really well. Certainly I would never go back as an ongoing basis. In terms of the cost, it's incredibly cheap.
Yeah, I've got a mate with a Tesla, actually. We were talking about this the other day, and I saw another post about it. As exactly you say, the upfront cost is higher, but the lifetime cost is lower. But obviously most people, especially families, they often can't jump that bridge, if you like, to that higher price from the get-go. So, but yeah, absolutely. It'll be interesting to see where it goes.
What's happening with Australian EVs at the moment? I know in Europe, for the last 6 months or so, we've had EV sales have been spiking. Has that been replicated in Australia? Have you seen?
I actually don't know. As far as I know, interestingly enough, I've got a guy that works with Mitsubishi. As far as I know, we struggle to get cars here at all. Like secondhand, the prices of secondhand cars are really high because we're like the last one that the global manufacturers want to send cars to because of the shortage everywhere. I assume they're going up, but I actually don't know the answer. It'd be interesting to find out. But I was going to comment before that when you talked about Australia and the carbon price, and sort of at a political level, the government doesn't push the renewable thing very hard or the climate change stuff. But at a people level, like solar panels are massive here in Australia. A lot of people will rally for climate change, and it's sort of like a disconnect between the government and big business, if you like, and what the people are doing. And, part of the trend of vegetarianism is the environmental influence of meat and all that sort of stuff. So it is kind of a thing where I think the groundswell from consumers will force the issue rather than the other way around.
Yeah, that's right. But just think also what would happen if you had a bit of more of a political will to tackle some of these issues as well. So I think that's a real opportunity in Australia for Australian investors. I mean, once that shift happens, and it surely has to happen at some point, you've got this groundswell of popular opinion. I'm simplifying things a bit, but when I've been in Australia, I see solar panels everywhere. With a bit more political leadership, I think your clean tech sector could really go to great heights.
The flip side, of course, is that at both the country level and various areas, like there are a lot of coal jobs in Australia, and they will be eventually wiped out. And obviously, those communities are like, well, what about us, kind of thing, which is legitimate and needs to be catered for. But like you mentioned Russia earlier, if gas and oil are gone, I mean, that's their entire export industry just taken away from them. So it's very disruptive what's going on. Very disruptive.
That's right. And these changes won't happen overnight, obviously. I mean, people have been forecasting the death of oil and natural gas for many, many years. It's not going to happen. I mean, straight away. I mean, oil, you might see oil demand go the same way as coal, essentially. It might sort of plateau for a long period of time, a relatively long period of time. And then as these EV penetration sort of really starts to bite in certain markets, then you might then see a real effect in oil market. But essentially, oil isn't going to go anywhere in a hurry. I think it's a longer term picture. We might see some real sort of declines in oil demand, but essentially, then the economy is it's still predominantly based on oil based goods and products. So I think we're stuck with oil for a little while longer, but I don't think we're going to be I don't think we're going to get oil demand rising much over the next few years, put it that way.
All right. It's really interesting. Obviously, these are all just touch points to what you're talking about. It's almost like an endless conversation and an endless spread of opportunity for you, isn't it? Like, so do you want to just to sum up? So for your focus for this year is graphite.
Graphite. And I just think the whole space, as I said, we had a tough sort of few months, start of this year. I think not just clean energy stocks. I think the wider growth side of things, tech side of things has come off. But actually the fundamentals for the whole space, solar, we're seeing solar generation go through the roof globally. I think this year globally we'll have more solar put on the grid in megawatts of actual generation than any other energy source. So solar is going through the roof. We're seeing similar in sort of wind. Carbon prices are looking really, really good. So much happening in hydrogen. Actually, lithium. But these stocks have come off. These stocks have come off sort of 30-40% over the last 6 months. And for me, that just represents just a massive opportunity.
It's so funny you said that.
Stronger. The
last podcast we did with a tech guy called Matt McCall, and he sort of said, a lot of the tech stocks he looks at are being smashed around, and it's opportunity. So when you talk about these long-term trends, it is volatile, and things do jump around. So you have to kind of know, are you in for the long haul? Because it'll be an exciting ride, but it won't be a smooth ride.
Not necessarily, yeah. But I mean, decarbonisation. I've seen it said that it's the biggest peacetime investment opportunity. Basically, since the Second World War, there's been no other investment opportunity with this scale of numbers that's ever happened. So, I mean, that just shows you that to reach our 2050 targets, we need to do so much. We need to invest so much more money. Just in clean energy alone, it's $100 trillion opportunity. And I just think we're still at the early stages. I think we had a great 2020. Prices have come off since 2021, and this really just represents just a massive opportunity right now. If you get in right now, I think over the long term, you should be sitting pretty. I think really everything is pointing in the right direction.
Beauty. What a great way to sum up. All right. Well, thanks for coming on, and we'll touch base again down the track, and we'll see what's happening with carbon prices, hydrogen, and
let's see what. Exactly. Let's see if I'm correct. But yeah, I think a 3-figure carbon later on this year. Let's hope so.
Cool. All right, buddy. Cheers.
Cheers, mate. Take care. Thank you.